Okay, so chapter 16, just write down these problems. We're going to do these in class. I'm going to give you a chance to work on them in a group. Quick study 16-3, quick study 16-4, quick study 16-6 and 7. Quick study 16-14. Exercise 16-3. Exercise 16-4. Quick study 16-8 and 9. I'm sorry, exercise 16-8 and 9. And exercise 16-12. So I'll call them again. Quick study 16-3, 16-4. Quick study 16-6, 16-7. Quick study 16-14. Exercise 16-3, 16-4. Exercise 16-8 and 16-9. And of course, problem 15-4A. Okay, so after reading this chapter, statement of cash flows, what is the main purpose of the statement of cash flows?
For money coming in and money going out.
Cash outflows, cash inflows. And so in reporting cash outflows and inflows, there are some questions that you're trying to ask is how does the company generate their cash? How do they spend their cash? And how does that actually explain the change or the effect in the cash flow? Now, who actually uses this kind of report, this kind of statement? Who uses it the most? Think about it. If it's talking about how cash comes in, how it goes out, and the effects of that, who do you think is going to benefit from it the most on the inside, internally?
The company.
Who in the company? How about anybody that deals with the day-to-day operations, right? Managers, all of those internally. Those are good morning. Those are the ones that deal with that kind of report probably more than others. So these are some of the important things of the cash flow statement. Again, as I said before, how did the company generate their cash? How are they funding it for the purpose of operations? Did they make any dividend payments from excess cash? Did they have enough cash to at least pay their debts at maturity? And did they borrow any money or have to repay any debts or any loans? So something that you also need to be concerned with as far as cash flow is concerned is the use of cash equivalents. And what do we mean by cash equivalent? First of all, cash is already converted, so you can use that freely, correct? Cash equivalent is something that can also be converted to cash because it is short term. right? Meaning within the accounting period or within the 12 months. So we can honestly say that cash equivalents are highly liquid, meaning highly convertible, quick to convert, and they sufficiently are close to maturity. So the market value is what? Not really changed by interest rates. Because sometimes, certain things affect a change in interest rates depending on the market by day, right? So these are the three activities or three sections of the cash flow statement that you have to be familiar with: operating activities, investing activities, financing activities. Now, operating activities are those activities that involve day-to-day changes, day-to-day cash inflows and outflows. So that means anytime that money is received for whatever aspect in that business, money is paid for whatever aspect in that business, then that's considered operating. If you look on page 635 in your textbooks at the bottom, they give you an idea of what the cash inflows are and what the cash outflows are as far as operating activities are concerned. So money received from customers for cash sales, money collected from customers for those who were on accounts receivable, any dividend received, cash dividends received from for the business, any interest received for the business, any settlements from lawsuits received for the business. All of that is a cash inflow as opposed to cash outflow. We know operating means that we have workers, right? They have to be paid for what they do. So that's a cash outflow. Of course, management, their salaries have to be paid. So that's a cash outflow. Anytime that the company has to pay interest, that's a cash outflow. Have to pay for their goods and their supplies and their materials, that's outflow. And of course, every business has to pay some kind of licensing, taxes, those types of things. That's all cash outflows. Up at the top of 636, you have investing. And this is that diagram for investing. Same thing, cash inflows and outflows. If it's an investment, that means that we are taking our money and we're purchasing things that hold value for the business, right? That we can use as leverage. So cash inflows from investing means if you are collecting any money from loans that the company may have lent out to someone, selling any securities that belong to the company, selling any kind of assets that had value, um, for the company, any kind of notes that were distributed. All of that's cash inflows. Cash outflows, if you make loans to other people, if you purchase more assets, if you purchase more securities, all of those things signify money going out that needs to be accounted for under this section. Financing activities, that deals with the loans and everything that probably are taken out, any kind of stock, things of that nature. Inflows, issuing their own equity stock. Of course, money is earned from that. Anytime an investor continues or an owner continues to invest money into the business, that's considered a financing activity. If they issue any long-term or short-term debt to their customers, then that is an inflow. And if they issue any notes or bonds, of course, that's inflow. Cash outflow, they have to repay any bonds that, any loans that they have possibly received. They have to also pay withdrawals that the owners have taken throughout the accounting period. They have to pay dividends to shareholders because we know that that is a requirement. And also, if they choose to purchase any treasury stock for the sake of value, that's a cash outflow under financing. So sometimes there are some non-cash activities that possibly take place. And keep in mind, when you're doing a cash flow statement, if you're doing a transaction or putting something on that cash flow statement and you're confused about whether or not it goes there, you shouldn't be. If it doesn't say cash, then it doesn't go on the cash flow statement. Everybody's clear, right? If it doesn't say cash, then it doesn't go on the cash flow statement. But if it's a situation like this, where we have non-cash investing activities, You wouldn't necessarily state it on the cash flow statement as a line item, but you would put it somewhere in the disclosure notes that it was a non-cash activity. So retirement of debt by issuing stock, conversion of preferred to common stock, lease of any kind of capital assets, purchase of any long-term assets, exchange of assets for other assets. None of that is dealing with cash. Purchase of assets using your stock or using the debt that you already have. All of those are non-cash investing and financing activities. So here is an example of the statement of cash flows. And as you can see, everything is pretty succinct, right? Those three activities in that same order you just learned them are placed on there. And then all of the activities that follow under those separate sections are listed. And I'll show you in a minute what it looks like in its entirety. That's just an example of what the format should be. So it says preparing a statement of cash flows. What's the first thing that you're going to do? Compute net increase or decrease in cash. And that's going to come from you doing those separate sections. Compute net cash for operating, compute net cash for investing, compute net cash for financing and activities. And then at the end of that statement, we should have an ending cash balance to go where? Where do you think that ending cash balance goes?
Under cash,
What statement?
the income statement.
Balance sheet. Okay. So analyzing the cash account. The reason why this is important because these are all the things that go on that cash flow statement. Notice the beginning balance at the end of 2012. Receipts that were money that was received from customers in cash. They sold assets. They issued stock. This is all inflow. On this second column, they paid for merchandise. They paid payroll. They paid interest. They paid taxes. They paid for some assets. Basically purchased them, paid for retirement, paid for dividends. All of that is the outflow section. But this is what the general ledger would look like for cash before you do the statement. Now, this is that same cash flow statement. It's just even more in detail now. Notice cash flow for operating, cash received from customers is expressed in positive, right? Cash paid for merchandise expressed in negative. Cash paid for wages and other operating, negative. Cash paid, negative. Cash paid, negative. So for anything where cash is received, it's reflected how? Received? Positive. And if it's paid? Negative. Cash flows from investing activities, received, positive. Paid, negative. That's really all you need to know. You need to know when to reflect it as positive, when to reflect it as negative. If it says received, then that means that it's a positive number. If it says paid, then that means that it is negative. So, second approach to preparing a statement is to analyze non-cash assets. Assets, this is just the accounting equation, right? Second step, cash plus any non-cash assets equals liabilities plus equity. Cash, changes in cash account are going to also reflect the same changes in cash and changes in non-cash accounts on the other side of the equation. Is basically what this is saying. So what are the things that you need to prepare the cash flow statement? Comparative balance sheets. The reason you need the balance sheet is because of what? Cash balance, right? Anything that dealt with cash, more than likely all those expenses that are on the income statement were paid with cash, so that's going to go on the cash flow statement, and any other additional information like beginning equity, stock information. So you got two different methods of preparing a cash flow statement. You can either do the direct method or you can do the indirect. They're all going to equal out to the same thing. They look different. Obviously, with the direct method, we are showing that we received cash from one group. We paid cash in one group, another group, another group, and another group. Indirect, we're showing every single time we paid out money, every single time we received money. Notice it starts off with something different. That's the main difference between direct method and indirect method. Indirect method is going to utilize what? What do you see on there? Here,
Net income.
net income. You didn't need that here. So they started off with net income and then they made adjustments to it. In other words, they looked under operating activities to see exactly how everything either increased or decreased so that they could subtract that ultimately from net income. So increase in accounts receivable. If it's an increase in accounts receivable, why are we reflecting it negatively?
Because it's liability, right?
Accounts receivable?
Right.
What kind of account is accounts receivable? It's an asset. But why would we decrease? If it's an increase, why are we reflecting it as if it were a increase? Take some time to think about that. And don't worry, it's in your books. When in doubt, look in the book.
Because if you decrease it, it implies that you have more cash at the end of the statement period.
Say it again, I'm sorry.
I'm saying like if you decrease it, it's saying that you have more money at the end of the statement than you had, or in that account, I guess.
These are some things I want you to highlight. Go on page 642 in your book. Under number 1, where it says adjustments for changes in current assets and current liabilities, highlight where it says decrease in non-cash current assets are added to net income. Also highlight increases in non-cash current assets are subtracted from net income. Flip over to 644. Increase in liabilities, what happens? We do what to net income? Add it. And if it's a decrease, what do we do? Subtract them. Go over to 645. Expenses with no cash outflows are done to what? Does what to net income? Add it back. Revenues with no cash inflows are what from net income? Subtracted. If it's a non-operating loss, what do? Add it to net income. And if it's a non-operating gain, subtract. On page 646, everything is right there on exhibit 16.12. Right? So decrease in non-cash assets, and my question was, if it was an increase in accounts receivable, why are we reflecting it as a negative? It was an increase, right? In accounts receivable. So it says their increase in non-cash current assets are what from net income? Subtracted. So that's why that accounts receivable was reflected negative, even though it said increase, because it's a non-cash asset and we subtract those from net income. Highlight that table or put a little asterisk or something by it in your book so you know to always revert back to that when you're doing an indirect cash flow statement. Look here on this example for Genesis company, increase in merchandise inventory. Is merchandise inventory cash?
No,
No, it's considered to be what?
non-cash.
Non-cash current asset, right?
Right.
So what are we gonna do? This shows an increase in merchandise inventory, so what are we gonna do as far as net income is concerned?
Subtract it.
Subtract it, right. Next line, increase in prepaid expenses. What are prepaid expenses?
Non-cash current asset. No.
Prepaid expenses. What is it? Yeah, like prepaid rent, prepaid insurance, and we know that that is a what? Is it a liability? Is it a? It's an asset. So if it is increased, that means we're gonna do what from net income? Subtract it. Okay, the next line, decrease in accounts payable. What is accounts payable?
Liability.
It's the liability. And when you have a decrease in the liability, what do you do to net income?
Decrease.
It's subtracted, right? Decrease in interest payable, that's still subtracted. Increase in income tax payable. So with an increase in a liability, what do?
Add to
You
the
add
income.
it. Add it to net income, good. So let's move on to this is the same table that's in your book. Cash flows from investing. They say that there's a 3-stage process. In order for you to determine cash, you got to identify what the actual accounts are, explain what happened, and then report their effect on that statement. So for instance, here on this balance sheet, just pulling out plant assets, which is not a current asset, and accumulated depreciation. From 2012 to 2013 in plant assets, there was a $40,000 difference, right? Increase. And then from 2012 to 2013 for accumulated depreciation, how much of a difference? 48,000 to 60,000. 12,000?
Yeah.
Okay. So with that 12,000 difference, what they're trying to get you to explain is there was a 40,000 increase and that there was a 12,000 increase in accumulated depreciation. And how do you reflect that in what we call reconstruction? Item B, they purchased plant assets. They issued a $60,000 note payable, paying how much in cash? $10,000. So in total, those plant assets were worth $70,000. $60,000 has incurred a debt, and we received $10,000 cash. And then item C, they sold plant assets costing $30,000 with a $12,000 accumulated depreciation. For $12,000 cash, resulting in a $6,000 loss. So to reconstruct the depreciation expense, they went from they debited depreciation expense 24,000 and credited 24,000 for accumulated depreciation. What is that actually saying when we're that last journal entry talking about reconstruction? They lost how much on the sale?
6,000.
6,000. And the assets were worth how much? 30,000. So to reconstruct, which basically means to show the loss on the statement itself, is by subtracting that 6,000 from what it was actually worth to show that now the depreciation expense truly is 24,000 and that the accumulated depreciation is 24,000. So now on to the cash flow statement of the investing part or investing section. They received 12,000 for that asset, right? They paid 10,000 for some other asset. So that means net cash provided by investing activities, 10,000 subtracted from 12,000 gives us a balance of 2,000 for the cash flow statement. Financing is still another three-stage process, right? Identify what has happened, explain what has happened by reconstructing the statement itself or the balances, and then show that on the cash flow statement. In this case, from 2012 to 2013, the long-term notes payable increased from 64,000 to 90,000, right? And then for common stock, it increased from 2012 to 2013 to 95,000. So that's a 15,000 difference. And then retained earnings increased from 88,000 to 112,000. That's us acknowledging what has actually occurred from year to year using a comparison. Now in item E, they have a note that is carrying a $34,000 balance. They retired it for 18,000 cash, resulting in a $16,000 gain. Item B. So what you need to be concerned with, what goes on the actual cash flow statement from reconstruction from item E. Which amount goes on the cash flow statement?
The $34,000?
The 16,000.
This.
Oh.
Look at it again.
Would it be cash?
Are you asking me or are you telling me? Because I asked you a question.
Cash flow, I'm assuming cash flow.
Stick with your assumption.
Okay.
Item B, Genesis purchased plant assets of 70,000, issued how much? 60,000 in a note, and they received 10,000. I mean, they paid 10,000 in cash. Which one of those amounts go on the statement of cash flow? Item D, issued 3,000 shares of common stock at par, 15,000. Item F, they paid cash dividends of 14,000. So when we go to the cash flow statement, we show that 15,000 from when they issued the stock. We show the 18,000 cash that was received from when they retired a note. We show how much they paid in cash dividends. Everybody sees that, right? What was the one thing you didn't see on there? We got the 15,000, we got the 14,000, and the 18,000. What didn't you see?
The paying cash.
The gain.
Yeah.
Not the gain. Which one of those transactions didn't you see?
The paying 10,000 cash? Why?
Why didn't you see it? Think about it.
Notes payable.
Not the notes payable has nothing to do with it. Why don't you see the 10,000 cash that you paid? You guys know this. Why did you not record the 10,000 that you paid for a plant asset in the previous transaction? When we purchase and buy equipment and all those things to invest in our business, where does that go? What section?
Cash flow investment.
Right. So the reason you didn't see the 10,000 under financing is because
Sorry.
it's up here when we paid it for plant assets, because that is an investing activity. That's why you didn't see it down there under financing. Everybody is clear? So now after the entire cash flow statement is completed, and this is an indirect method, but every time we complete a cash flow statement, at the very bottom, we show the net increase in cash. And where does that come from? The net cash that came from operating activities, the net cash that came from investing activities, and the net cash that came from financing activities are all added or subtracted from each other depending on how it's reflected. And that's going to show our net increase in cash. Now it says cash balance at prior year end. This is why the balance sheet is so important for the previous period, because that cash balance that's on there is going to be added to whatever the net increase in cash or subtracted from net decrease in cash from the cash flow statement is placed here. Everybody understand, right? No?
Yeah.
So where it says cash balance at current year end, if this is year end 2013, that means that this $17,000 cash amount is going to be where in 2014?
Net income.
But that, it's gonna be, yeah, the next,
Net
the
income.
cash balance from the prior year.
Cash balance, beginning balance for 2014. That's what it's going to be. Beginning cash balance for 2014. All right. Take a break. It's 9:54. Come back 10:15. And we're going to go over those problems.
You know what? You got this.
What sound is from Jordan? Quick study 16-3. Says use the following information to determine the company's cash flow from operating using the indirect method. So when we're doing the indirect method, what are we looking for per line item?
Don't we start off with the net income?
Mm-hmm.
See, I was confused when I was just reading this. This is
Start.
the year ended December 31st, 2013. And it has the net income, so what are we doing?
You just confused me because you answered your own question. You just told me that we use net income, right?
Right.
And did they give you net income?
Yeah, for year ended December 2013.
Do you have anything else?
So we kind of statement for 2014.
Yeah, it doesn't really, no, you're planning it for whatever year they tell you to plan it for, which they didn't really say.
Right.
So that part is not
Okay.
important, but yeah, that net income for this statement is what we use. So starting off with net income is how much? What's next?
No, operating expenses.
Operating expenses. And the way that the indirect method go, it would just be considered an adjustment.
It's 8,200 for net income.
Huh?
Yeah.
18,200?
Yeah.
Okay, so what's the first thing under operating cash flow do you list? What's the first line item?
Accounts receivable?
What did you have before that?
Oh, operating expense. But it got depreciation expense.
That's it. How much is that?
36,000.
So depreciation, 36,000. What else do you have?
Other expenses.
You just said it before.
Accounts receivable.
And what happened with accounts receivable? Did it increase or decrease?
It increased.
You sure?
From 2012 to 2013?
Mm-hmm.
Oh, my bad, to be clear.
So if we decrease from year to year, what do we do with net income? Say it louder.
Increase.
Increase. What's the amount?
$7,000.
Okay. What's the next line?
Merchandise import,
Okay. Does it increase or decrease?
increase,
Increase. And if it increases, it's a non-cash asset. So what do we do with net income?
subtract it.
Subtract how much?
$5,900.
5,900. What's the next line?
Accounts payable,
Okay. And what happened to it? Did it increase or decrease?
increase,
And when liabilities increase, what do we do with net income?
Increase.
Increase. How much?
4,700.
4,700. What's next?
Income tax payable,
Income tax payable. Did it increase or decrease?
decrease,
And since it's a liability and it decreases, what happens to net income?
is added,
If you have a liability that decreases, what do you do with net income? Decrease? Decreased how much?
$150.
Okay, so add all of these up. 36,000 plus 7,000 minus 5,900 plus 4,700 minus 150. What amount do you get? 41,650. And then taking this amount and adding it to your net income gives us how much for net cash?
59,800.
Thank you.
It's got to be the air conditioner.
Okay, quick study 16-4. The following selected information is from Ellerby Company's comparative balance sheet. The income statements report depreciation expense for the year of 18,000. Also furniture costing 52,500 was sold for its book value. Compute the cash received from the sale of furniture. So if we're doing cash flows for the actual sale of the furniture, how much was it sold for?
52,500.
Okay. $52,500. What was the accumulated depreciation
18,000.
at the beginning of the year?
Oh, is it?
It's 110,700.
And what was the you had a depreciation expense, was it an increase or a decrease from year to year?
It was
Decrease.
A decrease?
Is the person depreciation?
Depreciation, yeah.
Yeah, it's a decrease.
I said your depreciation expense. Depreciation, the income statement reports depreciation expense for the year 18,000. So so that means total expected accumulated depreciation. Are these two amounts added together? 118,000. I'm sorry, 28,000. What was the actual accumulated depreciation at the end of the year? 88,700. And we want to subtract that. What does that give us?
40,000.
40,000, and then what does, they said furniture costing was sold for its book value. So the new book value would have been how much if you subtract this from there?
48,700.
How much?
If you subtract what, 88? No.
40,000 from 52.
Oh, 12,500.
Why are we taking 40,000 negative?
Because it needs to be subtracted from
We're
the,
really just putting a minus sign in front of it.
You can do that, or you can express it in negative, either one.
Freezing or what, honey?
They're never gonna fix it, I don't know. I don't know if they- Quick study 16-6. And we're gonna go over more problems for this chapter next week as well. And then start on chapter 17 next week. But that problem, I'm removing it. Because what I realized is that we did not, what we did not talk about, we went over realized and we went over realized losses. However, what we did not do is when you're doing a fair value adjustment, we truthfully didn't do fair value adjustment for available for sale. We did fair value adjustment for held to maturity. We did the, it definitely was not available for sale though, that I remember. Yeah, oh yeah, that's what it was. Yeah, so we didn't do available for sale, fair value adjustment, which, so I'm gonna remove that one. So don't spend 3 days on that. I think it's due tonight though, right?
I've been working, me and him been texting each other for about 3-4 days, and I done asked some of my friends that graduated in accounting to help me, and nobody could figure it out.
Didn't have a hint at the bottom of it?
No, that's something where you have to basically go through the costing of each share prior to the investment, then incorporate the investment, then incorporate the adjustment, then also incorporate it. It's a lot. It's a lot to say. I probably would have had a lot of emails from it. If she hadn't said anything. Okay, so quick study 16 dash.
It's one chart for like 4 problems.
For 6?
Yes, because for 6 through 11.
Okay.
Yeah, you gotta use that chart for 6.
Oh, what did I say? I said 6 and 7, all right. So that's fine, because that's where we're stopping. So quick study 16-6, it says use the indirect method to prepare the cash provided or used from operating activity section only of the statement of cash flows for this company. So if we're using the indirect method, we start off with what?
Net income.
Net income. And how much was net income? And what were the adjustments? What's the first adjustment on there?
Chart 2.
Did you have depreciation?
For the furniture?
No, depreciation expense on your income statement.
Oh, crap.
How much was it?
37,000.
37,600. Okay, and what's next? And did your accounts receivable increase or decrease? So what do we do with net income?
Increase it by 10,000.
Okay. What's next?
When that inventory
Inventory. Did it increase or decrease?
decrease,
Decrease. So what do we do with net income?
increase it
Increase it by how much?
10,000.
10,000. What's next?
Accounts payable,
Did you have any prepaid?
Yes, we are. Prepaid expenses.
Prepaid expenses. Did they increase or decrease?
Increase,
Increase. And what do we do with net income?
decrease,
Decrease by how much?
1,200.
1,200. What's next? What's the next thing that you have?
I'm not sure when the furniture going in.
No, because your furniture is not a what? It's
Oh,
an
yeah.
asset, but it's a what?
It's a non-cash.
No,
Okay.
yeah, it's non-cash, but it's also what? A plant asset, long term.
Okay.
Okay, so
payable next,
accounts payable, did it increase or decrease?
decrease,
And what do you do with net income
decrease,
for accounts payable?
no decrease.
Decrease, what amount?
6,000.
What's next?
Would it be wage payable?
Wage payable, did it increase or decrease?
Increase,
Okay, and what do you do to net income?
increase it?
How much?
4,000.
What's next?
Income tax payable?
Income tax payable, what, increased or decreased?
Decrease,
Decreased, and what do you do to net income?
decrease?
How much?
1,200.
Okay. Is that all, or you have more?
Notes payable or?
Can't do notes payable because it's not what? Because it's not a long-term liability. Okay, so add all those together, 37,600 plus 10,000 plus 10,000 minus 1,200 minus 6,000 plus 4,000 minus 1,200.
$53,200.
Bless you. And so when we add these two together, we get net cash provided of how much?
83,000.
83,200. Quick study 16-7 says refer to data in 13-6, furniture costing $55,000 is sold at its book value in 2013. Acquisitions of furniture total $45,000 cash, on which no depreciation is necessary because it is acquired at year end. What is the cash inflow related to the sale of furniture?
Is it that 83,200? I thought you were saying the 9,000.
We gotta do it like we did that other one. How much did we sell it for?
55,000.
So you sold it for 55,000. What was the accumulated depreciation at the beginning of the year?
17,000?
At the beginning of the year?
9,000.
9,000? Yeah, for 2012.
9,000.
Okay. So, and what was the depreciation expense increase? Or what was the depreciation expense for the year? That's on your income statement.
37,600.
So that means expected accumulated depreciation is going to be these two added together, which was how much? 9,000 plus 37,600.
46,600.
46,600. And what was the actual depreciation, accumulated depreciation on that balance sheet for the end of the year? So you want to subtract 17,000 from the expected to give you the actual accumulated depreciation. The accumulated depreciation, which is how much?
29,600.
29,600. When you subtract that from how much you sold it for, that means that the cash actually received was how much? $29,600 from 55,000.
$15,400. Wait, no. 25,400.
Okay. So we're gonna pick this back up next week and do more problems. Those ones that were remaining. And then go into chapter 17.